Welcome, everybody, to this episode of the Mortgage Matters with Gretchen show, where I talk to real people in the field of real estate and business who are not only experts, but they're generous and willing to share their knowledge and their wisdom with us here today. And the goal of the show is for you to gain some information and tips to help you reach your goals in business and owning real estate, and to take some of the guesswork out of what to do or who to call in the process. And today, I'm very grateful to have David Young with me. And David is a chartered professional accountant. Hi, David.
Hello, how are you?
Very good.
Terrific.
David, sorry. You're good?
Yes.
Okay, awesome. David's practiced for over 35 years, specializing in tax solutions for personal, corporate, and estate tax clients. And when David is not serving his clients, he is actively involved as the executive director of a private day school. And he's also a member of the clergy in Toronto and a professional singer. Oh, and maybe he'll, sing for us. I'm not sure he's going to do that, but that would be awesome. So I first met David when a mortgage customer of mine asked him to reach out to his accountant, who is David, because I need a little bit of explanation on the corporate structure of that client in order to explain to the mortgage lender. And David was very lovely and able to help me and that client. And he has a great deal of experience helping people with, their personal taxes, people who are self-employed or owning multiple properties as well. And I have decided to use my personal accountant because he is very, very helpful and competent. And in a very short time, I realized he was able to help me much more than my current accountant, who had been with for quite a few years, had been helping me. So thank you for that, David.
You're welcome. Much appreciated.
Yeah. So please introduce yourself and say anything about yourself or your background that I haven't mentioned.
Thank you, Gretchen. Well, I think you've covered mostly all of it. The one thing that I always get a kick out of is the other side of my life, which you mentioned. Aside from doing accounting and income tax pretty much my whole life, I do sing professionally. I love it very much. I cater to a congregation. I do life cycle events as well. I perform at weddings and unfortunately at funerals. I help families who are in distress. I console those who are in mourning and rejoice with those that are celebrating life cycle events such as weddings, etc. So it's a varied background that provides me with lots to do. Most of the time, I'm up very early in the mornings, and I'm kept busy quite a lot during the day. But I do find that now I also have time to travel, which is great, and starting to explore the world. But thank you very much for having me. I really do appreciate the opportunity to discuss the topics that we're going to be exploring this afternoon.
That's great. You're very welcome. And you're a very well-rounded person. So that's wonderful. So I was very interested in having you as a guest because of my work, specifically with investors and self-employed people. When I first asked you about helping my investor customers, because they often ask me who can help me to understand corporate structures and should I have a corporation, they want to invest in real estate and consider the best structures. And you asked me if they were incorporated or not. So please explain, what are the advantages and disadvantages of being incorporated or a corporation?
Yes, thank you. That's a real interesting question. And really what we're essentially looking at is tax planning for the owner manager of a business. I have a number of clients who intend to purchase or wanting to purchase real estate, or who have already purchased investment properties. And they ask me, should I incorporate or not? And my answer is usually, it depends. It depends. What we have to look at is the overall tax planning strategy for the individual and his or her family. But what I do find that in many cases, when individuals purchase a rental property as an investment. In the first years, there usually is a rental loss that's incurred because the rental income is not great enough or high enough to compensate for the high expenses that are incurred in the year. So for example, the mortgage interest might be high. You have insurance, property taxes, maintenance and repairs. So a rental loss usually does occur in the first few years of owning property. In the case where an individual owns the property as a sole proprietor and not through the corporation, we can give this example that, for example, if the individual is earning $100,000 as an employee and is single, living in Ontario, and that's his only source of income, he'll pay tax, or she'll pay tax, of about $25,000. If, however, the person owns this rental property, excuse me, with a loss, let's say the loss is $25,000, this loss is included on the individual's personal tax return and offsets the employment income of the $100,000, which means that the tax now is not calculated on $100,000, but it's calculated on $75,000. The tax on $75,000 is approximately $17,000, so we already have a savings of $8,000 by having the investment property as a sole proprietor. Now, if we were looking at incorporation, we have a number of advantages of incorporating. I'm only going to touch on one major item at this point because I think it's quite important. The concept is called tax deferral. When we have a corporation will have a 12-month reporting period, and that 12-month period can end in any month within the year. Let's say we have a year end of July 31st of 2024. So we're going to report, that corporation is going to report on its assets, its liabilities, its revenue and expenses for the 12-month period, August 1st of 2023 to July 31st of 2024. Now let's assume that the rental property now is profitable and it's generating a net rental income of $100,000. The corporation will pay tax on the $100,000 at a different tax rate than a personal tax rate. It's a lower tax rate. But as well, the corporation can deem to declare a bonus to the owner or to the sole shareholder, let's say $25,000. That $25,000 will be deemed an expense and will offset the $100,000 net rental income. So the corporate tax now will be taxed on $75,000 at the lower amount. The caveat here is that that bonus must be paid within 6 months of the end of the fiscal year. So by January 31st, the corporation has to write a check to the taxpayer as payroll for $25,000. Because that check, let's say, is written in January of 2025, it's now included in that person's personal tax return in the 2025 calendar year. We know that when preparing a personal tax return, it's not filed until the deadline of April of the following year. So that tax that the person pays personally on that $25,000 is not paid until April of 2026. So you see, we have corporate tax savings immediately in July of 24, but the tax doesn't have to be paid on that bonus personally until April of 2026. That's tax deferral.
Okay, that's a very good example and a reason why people should consult with you. Because it's not like you said, it depends. Okay, so I've also heard that estate planning is an advantage of incorporation. And how is this accomplished?
Yes, this is one excellent example of savings or an advantage. And specifically, the scenario is if a person owns real estate as a sole proprietor and decides to transfer that property into a corporation, then the taxpayer or the corporation has to issue shares back to the taxpayer as consideration. These shares would need to be deemed preferred shares because preferred shares do not increase in value. They have a consistent value. So any gain on those shares from the point in time that based on the cost of that property to the point in time that it had an increased fair market value at the time of transfer, that gain on those shares are fixed. The tax will only be paid once those shares are sold. So if those shares are sold years down the road, it's still going to be based on the initial gain at the time of transfer. So because that gain is fixed, it's frozen, this is what we call an estate freeze. If the taxpayer wants to transfer the wealth or the future growth of the investment to his or her children, then the children, let's assume adult children in this scenario, the adult children will be issued common shares from the corporation. Common shares do increase in value. So when over time, if there's more properties or the properties increase in value, if those shares are sold years down the road, the gain will accrue to the adult children. But again, the preferred shares, that gain is consistent from the time the shares were issued to that taxpayer when the property was transferred into the corporation. So you freeze the gain to the initial shareholder, the owner, who transferred the property, and the children get the benefit of the increase in value of those shares over time. What happens in a situation where you have minor children? Minor children under the Income Tax Act cannot own real property. So what we do in this scenario is that just as the adult children would be issued common shares of the corporation, the children or even grandchildren can be beneficiaries of a living trust. And the trust will then own the common shares of the corporation and will pay the tax at that point in time when those shares are sold. So that is a very it's an overview of the estate freeze that provides advantages to the owners of the shares and advantages of incorporating the real property.
Okay, that's very interesting and helpful to know. And again, a good reason for people to talk to you. Yeah. So on a separate non-real estate side, let's say someone, they just have their primary home, but they're a small business owner like myself and are considering incorporating. When should they consider that, or what should they think about when making that choice?
Well, to answer that question, my advice in this case would be really to sit down with your accountant to review your overall tax planning strategies. What are your short-term goals? What are your long-term goals or strategies? One has to really have a picture painted of the individual's financial position, those of the family members, and really what the individual wants to accomplish over time. And that's really where we then determine if we should be incorporating or not. As I said, there are a lot of advantages of incorporating. There are advantages of not incorporating. there are disadvantages of incorporating, which we haven't talked about. But every situation can be different based upon the information and the variables that we are dealing with. So it's a matter of consultation, getting to know your client, getting to know your accountant, and having that communication to come up with the best scenario.
Okay, that's a fair answer. Okay, so many self-employed people like myself are probably not completing their taxes properly or as best as they could and could use your help. What approach or advice do you have for small business owners in that completing their taxes?
Well, very simply, I do find that there are a number of people who come to me who have done their taxes in previous years on their own and have used like a one-off tax software to complete the income tax. They usually claim that it saved them money. They knew what they were doing and went through it in that along that path. But one drawback is that, you know, tax software really can be deemed by the non-professional as a glorified calculator. It does calculate the tax for you, but as a small business owner, there are many deductions that are available to you, both as a sole proprietor or as a shareholder of a corporation. There are many different scenarios that can take place. So one should always seek out professional advice, and with the objective of mitigating your taxes to the greatest extent possible by claiming deductions that are allowable under the Income Tax Act. That's really the way to go.
Okay, that makes sense. Okay, what other issues arise regarding taxes that all homeowners should know, not just those who are self-employed or landlords?
Good question. For those of you that do not own real estate or have investments that are earning income and are own a home or even rent a home, there are a lot of benefits that you can that can come to you just by filing a tax return, even if you have minimal income. One example I can think of is renovations. People do a renovation to their home and they are seniors, 65 years of age or older in Ontario. Then if the renovation is made to make your home safer and more accessible, you get to deduct these costs and get a special tax credit on your return. That's one item. Another item is that those that pay rent in Ontario with minimal income or even some income can qualify for what's called the Ontario Trillium benefit. Again, depending upon one's income threshold, by filing a return, you can claim a GST credit as well as the Ontario carbon rebate. One item that I find is missed by a lot of clients is that when purchasing a home for the first time, I've noticed they do have a home buyer's plan through an RSP, but buying a home for the first time, you can qualify for a special first-time home buyer's tax credit. And that can save you $1,500 on the purchase of your new home once you move into that new home. And talking about moving, people who move from one location to another and are 40 kilometers closer to their office of employment can deduct moving expenses. Moving expenses, one wouldn't believe what you can deduct. Not only can you deduct the cost of moving, but get this, there's a storage cost of vehicle, meals, You can deduct 15 days worth of accommodation if you're in transit. If you are renting a property and you're moving into a home, you can deduct the cost of canceling the lease. And there's incidental costs that you can deduct. If you had to, the cost of changing your home address, your driver's license, if you are, if you have the cost of hooking up utilities or even disconnecting utilities in your former property, they're all deductible. If your home is vacant, the previous home that you're moving from is vacant, you can claim up to $5,000 of expenses of carrying that home. Mortgage interest, property taxes, insurance. So there really is a gold mine of deductions when moving from one home to another, which is really very, very beneficial to the taxpayer.
Yeah, I've not heard of most of those. So the dollars are adding up of savings when people just, yeah, just reach out. So
Yes, yes.
that is really important to know these things. So thank you so much for that. So what's one last piece of advice you would have for Canadians right now?
Well, I'd like to say that it's really easy not to pay attention to your tax or preparation of your income tax. I have a lot of clients who have avoided completing their tax returns. Some going back even like 10 years. And you'd be surprised if those returns had been filed on time, then there was the possibility of obtaining refunds in the thousands of dollars. Conversely, by not filling out or completing a tax return, if you owe tax, then the interest and penalties are exorbitant, and it can prove to be extremely costly. So my advice is, and one other point I'd like to mention is that a lot of clients go to a big box firm or may go to a big box firm to have their taxes done. They charge a lot. They want to complete as many returns as possible in the shortest amount of time to maximize their own profit margins. The drawback is that you're missing that personal approach. There isn't the time to get to know the client, to develop that relationship that is so important in order to understand what the true needs of the client are. So it's my intention that, and advice that I can provide is to get an account. First of all, do your returns annually, get an accountant or a tax professional who wants to take the time with you, who wants to get to know you, who cares about you, and wants the best for you. And really, that's the best advice that I can give at this time.
I think that's very valuable advice. So thank you so much for that and all of your other answers. And what people will want to know is, how can they reach you? How can they find you?
Thank you. Yes, I do have a website. The address is www.davidyoung.com. My email address is davidyoung1836@gmail.com. And my business number is 416-473-0432.
Okay, that's great. And I'll make sure that information is also available on the social media platforms where everybody be connecting and seeing this information. So David, I'm so grateful that you've talked to me today, and I really look forward to sharing this with other people because it's so valuable and important and such an area that's not well understood, or it's just a missed opportunity to not reach out. Thank you so much.
Thank you. I appreciate it.
You're welcome.